right. My only other job is to announce the moderator of our next panel, and I'll let him introduce his speakers. Rob Klein is currently a managing director at Evercore, working in the firm's corporate advisory services. Some of you know Evercore is an independent investment banking advisory firm, headquartered in New York, offices all across the US, Europe, Central and South America, Asia. And if you can see from his bio, I won't read it to you, but he's significant experience in representing public and private companies across the whole spectrum of activities, mergers, acquisition, ventures, strategic partnerships, portfolio acquisitions, IPOs, et cetera. After graduating from the University of Florida's honors program with a degree in business, Rob started his career at Goldman Sachs. He then made his way to Columbia Business School to get his MBA. From there, he worked for Rexon Associates, a publicly traded real estate investment trust. Prior to joining Evercore, Rob was a vice president at MJC Associates, a boutique investment banking firm, which was the predecessor to the Evercore real estate team. And I'd also just like to add that Rob's been very involved lately in the Masters of Science in Real Estate program and in the Masters of Science in Finance program, so it's been great to have you back on campus so much. So thanks, and I'll let you take it from here.
Thank you, everybody, for showing up for the first event of the morning. I hope everybody's caffeinated and ready to participate here. We've got a great panel. The purpose of this panel really was to bring a different element to the conference here, to talk a little bit about the differences between being a public company and a private company, some of the challenges and some of the advantages that occur in both forms. With me, I've got three distinguished guests, and don't hold their school affiliations against them. We've got Tim Wallace, who is the Chairman, Chief Executive Officer, and President of Community Healthcare Trust. We have Nelson Mills, who is the CEO of Columbia Property Trust. And we've got Louis Petheridge, who is the CFO of DDR Trust. And again, just for full disclosure, we've got a Kentucky, Tennessee, and Ohio State fan. So again, don't hold it against them. We're going to try to convert them by the end of the conference. So maybe we'll start out with just a general topic, and we'll just see how it goes from there. Tim, Nelson, you guys have been C-suite executives for private and public companies, and Luke, you as well, in addition to managing JVs with both. I want to talk a little bit about kind of what forum you guys prefer, the public or the private forum, and let's maybe just open up a discussion about that. So Tim.
Well, I probably come at this a different angle than most people in the crowd because I'm an accountant by training and spent 12 years in public accounting. So my first adventure into the actual real estate world was a founding member of Healthcare Realty Trust back in 1993. Having my background in accounting, the public side of it didn't really bother me. So we did that. I did that for 10 years and then left, and then I spent 12 years on the private side. And now I'm back in the public side. So I guess probably by definition I'd have to say I like the public side better. And as I tell people, when they ask why, it's kind of like when we finished the IPO for Community Healthcare Trust last year, people gave us $130 million that we never have to give back. How can you beat that?
Well, I'd say it's, it depends. It really depends on the stage of the market cycle, right? So today, we and most of our peers are trading about 25%. As a public company, we're trading about 25% below our net asset value. So not a big fan of the public model right now, but there are pros and cons to each. There are many days I miss the private equity model. Obviously, any capital is demanding, as they should be. Our business is challenging in any format. But one thing I would say about the public forum is there's almost always access to capital at some price. It never completely shuts down, but it's a bit cumbersome. You know, it's very short-term focused, and you have to really, in our business, in the real estate business, these are long-term decisions. So you have to really be disciplined and not get distracted with the shorter term. But it is a wonderful vehicle in many respects.
Yeah, I guess, you know, coming from the perspective of working private, my accent is definitely from Ohio. This is the way we speak up north. So when I took companies public in Australia, you know, that we started private, but it is really hard to raise capital, as Nelson made the point. You know, raising money when you're public, there is a price and there's a market price for when you want to raise money. You know, for DDR, we've raised over $2 billion of new capital in the last 5 years, which I think in the private space, unless you're like a Blackstone, it is really hard to do. So I think, you know, it's at different points in the cycle. It's also different to asset classes as well. I think, you know, some asset classes make more sense to be private and some asset classes make more sense to be public. You know, you think about the people that actually own and control a significant amount of the public money are young analysts sitting in New York. You know, they like to own assets that are in, you know, really high barrier to entry markets where you can still make money in some of the other markets. It just makes it a little harder to get engagement. I think the biggest issue, and this is where the fundamentals change, that the fundamentals of real estate aren't always incorporated in your price. If you think about real estate, it's a decade-long investment where you've got investors that will see us, you know, probably 10 times a year. And they say, yes, a decade is made up by year and a year is made up by quarters. They look at quarterly performance. And it's like, how do I make decisions on long-term shopping centres every 90 days? That makes it a little difficult. So I think public is a good way to do it once you get scale, but you just do need to understand that there is going to be ebbs and flows which are driven more by financial volatility than real estate.
So maybe let's stay on that topic, Luke, for a second about the long-term nature that real estate is really set up for, but the short-term nature under which you have to report to your your investors, the research analysts, and the whole community that's looking to invest in your stock. How do you deal with that? How do you manage a long-term business on a quarterly basis?
I think, you know, one of the big things that we've been focused on is really focusing investors on NAV. You're really trying to focus on this net asset value and creating value in the real estate, not so much on short-term FFO. DDR was a poster child of getting that wrong in the last downturn. It was so FFO focused, you can artificially or even financially engineer some of your returns and your FFO, but really the key is to focus on long-term. I think right now is really hard. I mean, we just came from the Wells conference where you sit in a room and meet, you know, 30 investors in a day and you're just getting beaten up by, you're trading at a discount, why aren't you buying back stock, why aren't you, you know, it makes it difficult. So I think you've got to stick with what you're focused on. And then if you really look at the blue chip companies in the sector, you look at someone like a Federal or a Simon Group, they've done that for many, many years. And once you do build a track record, I think people do actually start to value you closer to NAV.
Yeah, those are great points. The same conference, the same beating up the last few days. But I think you really have to define the conversation. You have to shape the conversation. The focus tends to be short term, next quarter's earnings. We just went through a strategy over the last 3 years. Take it back just a second. So our company was formerly a non-traded REIT, really geared toward the mom and pop retail investor, paying a nice dividend for a long period of time, but not focused on growth. So we had $5.5 billion of assets in 32 markets. 20 of those markets had one asset each. What we're really doing was buying long-term leases. Now we had high credit quality tenants, a lot of single tenants, a lot of suburban, and they paid a nice dividend for a long time until they don't anymore, right? Until you go through 08 or 09 and it exposes all that. So we were getting ready to list the company, so we said we've got to shift the strategy to an NAV focus. This is office real estate. We have to focus on the long term. We have to focus on NAV growth. So we sold 47 of our 78 assets, and to keep the analysts happy that you mentioned, not just for that reason, but for other long-term trend reasons, we shifted our strategy to these gateway markets. To do that, we had to cut our dividend in half. Not easy and not popular. But I think the market, the institutional market, is beginning to embrace that as a longer-term strategy.
Yeah, I think you're right about that. So, you know, along these lines, Tim, do you think that there is something to the discipline of being in a closed-end fund or something with a finite time horizon, or do you think it's more advantageous to have the $130 million that you don't necessarily have to give back to investors?
Well, I'm gonna combine comments related to the previous question and this question, because basically what you have to do, and this is whether you're private or public, is you have to manage your investors' expectations. You have to tell them what your game plan is. You have to have a good game plan. You have to have that business plan, and you got to do it. And then you got to go back and tell them periodically, again, this is whether you're private or public, you got to tell them, here was the game plan, here's what I told you I was going to do, here's what I've done, here's what we're going to do next. And from that standpoint, I don't think it's that different between public and private. I mean, yeah, you do it every 90 days on the public side, but again, if you're managing the expectations correctly and don't let something get out in front of you, then you're still fine. And I have found it easier to do that really on the public side than it is on the private side in a lot of cases. So again, I don't think from that standpoint it's really that different.
So there was another topic that kind of came up in the initial comments here, which was about NAV and about where most stocks, if not almost all stocks, but for maybe the storage sector, are all trading at a discount to NAV. And we've got an esteemed colleague and board member out here, Dirk, who's at Green Street, and Green Street has been kind of pounding the table on the research side that an effective use of capital for public companies with discounts to NAV should be to buy back their own stock. And I'm curious kind of what you guys all think about that, because that is a little bit contrary to when you think about what a REIT is really set up to do, which is to be a kind of perpetual capital source that is growing in size, that is distributing all of its income, and should be thinking more about issuing shares than buying back its own shares. So maybe we'll kind of reverse it back. And then Nelson in particular, I know you guys have an active mandate from your board to buy back shares, and you actually have been active in the market doing so. So maybe we'll go back the other way around, Tim, and I'm curious how you feel about that as a newer company in the market and then you guys as more established companies.
Well, I would say it's really based upon where you are in the cycle and where you are based upon where you can make investments. I mean, I always viewed this, and again, this is my second go-around on the public market. I spent over 10 years in healthcare realty. But the way I always viewed it is, can we invest better in the real estate, or can we invest better in our stock? And there's lots of things that go into that stock analysis, just like there is in the real estate analysis. So, I don't think there's one that's better or worse, and I think what it is, it depends on where you are in the cycle, what your alternative investments are, in that long-term analysis. And frankly, it has to be a somewhat compelling story to buy back the stock, because we see lots of opportunities to invest in places that, and again, we're new to this and we're on a growth cycle up, but we see lots of places to invest our capital at places that we think are accretive and growth to the stock price in the future.
And just for the audience, if you don't know Community Healthcare, they went public last year in May, so they're coming up in a couple months on their one-year anniversary as a public company.
So we listed the company in October of 13, so it's been 2.5 years. Almost from the beginning, we had some pressure from shorter-term investors to buy back shares. It tends to stimulate price. They're the quick in and out, and so we get pressure early on. And it was, we dealt with that. We communicated around that, but we resisted. We don't see share buybacks as part of any strategy. It doesn't inherently create value. It's a tactic. And like Tim said, there are points in the cycle, and there's points in your timeline that makes sense. So, for example, let's take for purposes of argument that our NAV is 28, 29. That's probably not far off, although we don't really publish that. But let's say when we were trading at $25, we were getting pressure to buy back shares. Oh, it's less than your NAV. It's accretive. You should buy them back. Well, that's we didn't see that at all. There's what are you going to do? Reissue when just the friction of buying back and reissuing doesn't make a lot of sense to us. Second of all, we're focused on our strategy. You need capital to execute the strategy. Now, our view all along has been, if the discount's deep enough, which today it's 25%, along with a lot of our peers, If we have the capital, we're not going to borrow money to buy back shares, but if we have the capital, and we do because we've just sold several assets, and if there are no other compelling alternatives for investment that we think meet our strategy, if those three conditions exist, then sure, we'll buy some shares back. But even then, you're limited on how many shares you can buy per day, and so you can't really move the needle. So it's another distraction, right? So it's an important tool to have in the toolbox, but if really it's just a partial liquidation, right? And if you don't believe in your strategy and where you're going, then maybe you shouldn't just be buying back a few shares. Maybe you should be buying back all of them, right? Maybe that's, so it's a matter of degree.
Yeah, and I guess you have to also weigh probably the numerator denominator problem of FFO per share matters how many shares and how much FFO you have, and so does the denominator move the equation more than the numerator in buying assets versus buying back shares?
Yeah, for DDR, we're in a slightly different position. We're probably nearly 20 years as a public company. We have an equity cap of almost $6 billion, so a significant amount. We do have slightly higher leverage. I think the one aspect of a buyback, no matter how you do it, you are taking on more leverage. So even if you're using cash flow, you could be paying down debt. You are levering up the company. So for us, you need to, as the others mentioned, you do have to look at the discount. I think we say the discount has to be deep enough and persistent. I think you do need to say there needs to be some sort of persistence there. It's not short term. Otherwise, as they mentioned, you'd be in and out buying stock all the time. That's not the point of the REIT. And I think it's also, can you reinvest a significant amount of your capital inside your portfolio, which we believe we can at the moment. But you do need to take into account some of the financial impacts to your balance sheet, I think, before you take on because once you buy the shares back, you've bought them back. It does turn it hard to actually flip it around the other way. So I think there's some of the aspects you need to think about before you decide to buy back stock. But I do think the flip of that is while you trade at a discount, it does make it hard to grow as a public company. I don't think you see too many people issuing stock at a deep discount to NAV.
So with you guys flipping your investor hat on, do I buy back shares, and your company hat on of what's best for the company, you have to have an eye on the market of where real estate values are, where your stock values are. And, do you guys think the market's got it wrong, the public market, in terms of valuation of all the public stocks in the REIT market, or do you think the private market's got it wrong where it's valuing real estate too expensive? Maybe Nelson will start.
Well, I think it's a combination. I think there's the right answer is somewhere in the middle, but I tend to think the private capital is a little closer. And what I base that on is just our recent experience. As I mentioned earlier, in the last 3 years, and even as recently as 6 months ago, we've sold $2.5 billion of assets in various markets, 47 properties, as I mentioned. So we have a pretty good barometer for what those prices are and how that plays into our NAV. So it's really validated what the NAV is in an open, fully marketed, efficient sort of marketing system. So, I think the prices are, private prices are a little closer to reality, and then there's a lot of noise in public markets in general, but in the REIT sector in particular. But it's somewhere in between.
Yeah, I'd probably agree with that. And I think then it comes down to, if you think about what is one of the main goals of a REIT management team, is capital allocation. Those that allocate capital the best over multi-decades are the winners, David Simon being a prime example, or Don Wood, Steve Gutman at Federal being another good example in our sectors. So I think then what you do is you heed the public market signal. If public markets trade you wide, you sell assets. And DDR has been the exact same boat. We have been one of the largest net sellers in our sector by selling, $3 or $4 billion over the last few years, and we'll continue to do so. If we continue to think that the private market is paying above public market prices, then I think as a public market you would do that. Conversely, for our particular sector, back in 2013, it was the exact reverse. Our stock was trading above our implied NAV. We felt we could acquire shopping centres better than our cost of capital. So I think it is something that you do have to remember. It is such a long-term game, and I think you need to be able to take, or at least be able to utilise your balance sheet and capital when you can.
Any thoughts?
I have a lot of thoughts. I don't know that I have enough time for all the thoughts that I have on on this. And one of the things that I'll say is, does private have it right? Does public have it right? I don't know that either one of them has it right or wrong. They have different objectives. They have different views on life, so to speak. And one of the things that I have been, I guess, most intrigued by getting back into the public side is the focus on NAV. And the real question is a REIT a collection of real estate assets, or is it a company? And I always like to think of it as a company, which means it's more than just a collection of real estate assets. And we focus on growing our FFO, and we focus a lot more on that than we do on NAV, because the way that I learned real estate is you can make a lot of money in it if you're buying where other people aren't. And that's basically the basis of our strategy. I mean, there's lots of different strategies that work, but the basis of our strategy is buying where other people aren't. And I look at how people calculate our NAV, and they do it at a substantially higher cap rate than other people's NAVs. And then I look at, like, Ventas acquired American Realty Capital's healthcare REIT, 1, 2, or 3, or one of those. And they did it at a cap rate that was like 2/3 of what we're buying stuff at in the same markets. And we're like, okay, so if Ventas bought that and it's valued at a 6 cap, and we're just down the street and we're buying stuff at a 9 cap, how do you compare those NAVs? And I think it's really difficult in that scenario. I mean, and I could go on about this for some time, and I won't, but I don't think there's any one metric, and I think right now that a lot of focus is being placed on NAV, where there ought to be a lot more metrics involved. And my company is not just a collection of assets.
Tim, just let me add on that. I think that's a great point, because it is, at the end of the day, about FFO growth. But the two concepts aren't inconsistent, right? So NAV is just, the net present value of the future income stream. So if you're growing FFO, you're growing future income, you're growing NAV, and the two are related. I think it's maximizing growing FFO is a great focus. Growing FFO is a great focus. Maximizing FFO per share isn't necessarily a great focus. For example, if you have a property in suburban Winston-Salem, single tenant, and you sell that it's an 8 cap, and you sell that and you give up an 8 yield, and this is a couple of years ago, you buy downtown San Francisco for a 3 or 4 cap, right? But the in-place rents are half of market and near-term roll, and there's growth there. So if you look at just FFO, which will give you the best FFO next year, and that's not what Tim is saying, but what will give you the best FFO next year? It's the Winston-Salem single tenant asset. Don't sell that. That's an 8 cap, and buy a 4 cap. But in terms of growth, at least a couple of years ago in San Francisco, there's no question where more growth is. So I think we can fall in the trap sometimes with a focus on FFO, and that's not what Tim's saying. Tim's talking about growing FFO, which I totally agree with. But if you focus on FFO, it can lead you down a short-term path that doesn't necessarily derive the best value long-term.
Yeah, and let me address an issue on that, because we have addressed that in our scenario, and basically it is, I'm very proud that all of my executives, everybody in the company in 2015 elected to take all of their compensation in stock. My directors, my management team, everybody in the company took 100% of compensation in stock. And it's forfeitable for 8 years. So there isn't the ability to jack with FFO over a very short period of time for anybody's benefit. And again, this year, I think it's like 88% of all compensation in the company has been taken in stock. The C-suite guys have committed for as long as their employment agreements are in place to take it, and all of it is 8-year cliff forfeiture. So that way, if what you do is you build a company, and again, my company is more than just the assets that it has. I've got a management team that's committed to it and has proven that they're committed to it by taking all compensation in stock and leaving it there for a very long time.
That's the ultimate share buyback, isn't it?
When you think about if we are really roaming into FFO, it's a metric that you can lever up and make it work, or you can as Nelson mentioned, keep higher cap assets, not sell some today's yield for long term. But the one thing I will say is if you look at REIT performance for the last 20 years, so over the last 20 years, 1 year defined where you ended in that scale. It was all about 2009. If you were prepared for the downturn, you had good assets, well levered, and was prepared, you are a top quartile performer. If you weren't, you are at the very bottom of the list. So, when management teams look at that, chasing yield and chasing short-term returns over a decade is actually going to be problematic. And I think, management teams that actually think about that and focus on that, I think will be the ones that will be long-term rewarded. May not be in the bull market. Selling weaker assets in a bull market isn't popular. It absolutely isn't. Selling an 8-cap, people are absolutely saying, how does that impact next year's FFO? But when you tell them you're selling an asset that has a H.H. Gregg and a Sports Authority in it, and they go bankrupt in a year, you say, well, exactly, we got that right, and you've bought something that actually has significant growth in it. So I think the focus on long-term returns, everyone in the public side will say that, but then they still sometimes just revert back to the short-term performance.
So I think everyone in the room that's a shareholder of a company has opinions of the companies they own, the typical institutional investors as well, but there's been a new crop of more vocal investors in the REIT space, the activist investors. And you're seeing them, some of them have significant capital, and then there are others that have very little capital but have a large voice in the market. I won't throw out any names, but we all know who we're talking about. I'm curious why you guys think that this resurgence of activism has happened, or even the emergence, I guess, in the REIT space in a big way. What's going on to create that? Why are these investors becoming more vocal now than they have over the last 10 years? And what do you guys think about in terms of defending yourself, making yourself ready and capable for handling them when the fight comes your way? So I don't know, maybe Nelson.
So I think the so-called, the activism role is important, and we can point to many examples over the decades where it was needed, right? A management team or a board wasn't doing right by the shareholders or by the company, and didn't, quite frankly, seem to care, right? So I think the activism has a meaningful role. It seems to have taken on morphed in, at least in some cases, more of just a quick, short-term, opportunistic deal for the activists themselves and their investors. For example, we really haven't been exposed to that very much. I mentioned earlier, I think activism because a team over years and years erodes value and is one thing. Somebody stepping in because they want share buybacks. You're 10% below NAV and they want a share buyback is a different matter. So, and I think if you're, like Tim said, if you're communicating your story and you're consistent and you're performing, I think that's your best defense. And try not to get distracted by it. I think that wins out in the end. But at the same time, if there's a point to be made, management teams should be listening. Like I said, I think in balance, it's a useful part of the system, but it does have its extremes for sure.
Absolutely. How about you, Luke? What do you guys think about it, and how do you?
Yeah, I think, holistically, I think it's good for the sector. It almost puts the check in. And if you think about real estate, it was the one sector that had the most entrenched boards over multi-decades, whether it's families taking things public. So I do think there is a role for that, but I do the caution of some of these guys are more of a hedge fund, very short-term nature from activism. I think that's probably, you've just got to remember that the short-term nature of activism versus the long-term performance of a company. But I agree with Nelson, it really comes down to you've got to articulate your story, articulate your strategy, ensure that investors understand exactly where you are and where you want to try to take the company. And you aren't just a collection of assets, you are trying to do something, and this is the bet we're making on whether it's a theme, on a sector, on a market. And I think what happens is your shareholders understand that. I think where you do get into trouble is when you don't listen to shareholders, when you decide this is what we're going to do and it's for the benefit of maybe other constituencies. I just think if you're very clear with your message, I think that's sort of probably the best defence.
It makes sense. And Tim, I know again, it's you're only one issuance into the market, and activists haven't started clamoring around you too much yet. But at some point, they like to circle and they like to look for things that they find of value. I'm curious how you guys think about it as a new entrant to the market.
Well, and I did have 10 years at Healthcare Realty also that we dealt with some of it back then. I mean, and I agree with both of these guys. I mean, if management's not paying attention, then they need something to bring them to light. I think quite frankly, the reason that it's kind of become back in now is because since 2007, 2008, as Luke said, I mean, real estate's kind of had the tailwind to it. So everybody, all you had to do was invest in real estate and you got it right to an extent. You may not have been as right as you could have been otherwise, et cetera, but now we're to a point where, real management really matters. And if the management team isn't focusing on what they should be focusing on, they should get it right. I mean, from our standpoint, again, that's why we have the alignment of interest that we have. As I've told people from the beginning, our stocks for sale every day. I mean, if somebody wants to come in and buy us, and, we're shareholders. So, we're going to make sure that we try to get the best deal for the shareholders and move forward based upon, what the shareholders and what the market says.
So maybe on the topic of shareholders, and then I don't know if we have the microphones in the audience, but maybe after this question we'll open it up for anybody that wants to talk to any of our panelists. But in terms of shareholders, you've all have very different constituencies. Nelson with a larger retail base than the others. DDR with one main shareholder that came in during the crisis. And then Tim, you guys with your management structure, and then with kind of a little bit more of a traditional base from a great roadshow and IPO, may I add. How do you guys deal with your different constituents? Nelson with the transition from retail to institutional, and Luke in particular with one shareholder that's quite vocal, quite active, and quite experienced in the space. So maybe Luke will start, and we'll just kind of come back this way.
Yeah, so we have one large shareholder, Alexander Otto, so owns one of the largest mall portfolio in Europe, so multi-billionaire. He owns about 20% of our company. So again, as was outlined by Rob, he bought in the crisis, helped stabilize the company. One of the very, very big benefits of that is it's very sticky money. He is very, very long-term investor. And he provides a very long-term perspective in the board. I think that's really helpful when we have discussions, and also other shareholders like to know about that too. So I think from a pure strategy point of view, when we're talking about where we want to be in 5 years, he's someone that will be very vocal about that. He has very little, he obviously notices the share market, but he understands real estate's cyclical, and he takes a longer term bet. So I think there is a huge benefit to having an anchor investor. The rest of our shareholder base, I'd say 70%, 70 to 75% is large institutions. It's the 35 REIT dedicated funds. We've got 31 of the 35 invest in DDR. So it's where it's the Wells Conference or NAREIT, we're seeing most of our investors on a regular basis, and they vary. Some of them vary and say we're very good about long term. Others have a much more short term horizon. So, but I do think it still comes down to just so long as you're consistent with your message, saying this is where we want the company to go. We have a very simple and clear strategic vision for the company. I think all shareholders do come together. I do like the idea of having a very, very long-term shareholder and others that are a little more short-term.
And Nelson, have you noticed a big difference from the days when it was all retail investors to now where you've kind of shifted that balance to being more institutional than retail?
Well, there are some differences. There are more similarities than differences. Most investors I know want to maximize their returns, would like to get more money back than they put in. So, but it is very interesting, very different, because as I mentioned, we had 134,000 retail shareholders. It was a non-traded REIT, and they were paid a very nice dividend, around 6% dividend for several years. When we decided, but now we need to provide liquidity. They need their money back at some point. So we were going to list the company, and to maximize their price, we needed to build a portfolio, build a team, build an operation that would be most attractive to that new investor, and most new capital is coming from the institutional side. So we had some investors early on to say, wait a minute, this is not what we bought into. This is a dividend REIT. You're changing to a growth strategy. You're cutting my dividend. And, well, we could keep the dividend for a few more years, but you may only get $7 of your $10 back. We're trying to get you 10 or 12 of your $10 back. So, but I think in time you communicate the story. I think they understand. I think we all agree here we serve today's shareholders. We're not trying to swap out yesterday's shareholders for tomorrow's shareholders, but we best serve today's shareholders by making the company the most attractive to the market, new investors, existing investors, and so forth. And if we do that, all investors will benefit.
And maybe, Tim, I'll change the question for you a little bit, because maybe for the audience it would be a little bit more interesting to know, you went through the IPO process recently, and what was it like trying to attract investors, trying to deal with people that may have had a lot less experience in the real estate industry than you did, trying to convince them to invest in you, trying to get over all the hurdles of not being the standard type of product type, the standard size, the standard everything, but yet getting out successfully. I'm curious how you felt the process was in attracting those investors.
Well, and actually, we ended up being over 70% institutional, which I was extremely surprised by, because I had some large investment banks tell me we'd have to do 100% retail because we were different. And again, you just got to communicate what your strategy is and get them, because I went into this saying we were not REIT mafia material. And yet, if you look at our shareholder base, Prudential is our largest shareholder now. Goldman Sachs Asset Management is in the top 5. Wallington's in the top 5. So we've got some very, very good real estate investors. Now, one of the things that I found very different, and again, this is comparing 1993 to 2015, is in 93, when we did the healthcare realty IPO and you went to Cohen and Steers, you actually sat down with Marty and Rob. If you went to the Barron funds, you'd actually sit down with Ron Barron and talk to him. And they were investing their capital and had hands-on. Now you go to so many of these places, and nothing against the current students or anything, but you get people who are sitting across the table from you who want to fill out a model. Basically, their whole goal in life is to fill out a model so that they can make a determination. And they're 27, 28-year-olds, master's degrees, and they've never run real estate. They've never owned any real estate. They probably don't even own their house, and they've never made payroll. They've never done all the other things that goes into running a company. And you're sitting across the table from them, and you're going like, and these are the people making the decisions on investing dollars. And again, it's just part of the system now. So we went through it, and obviously we were fairly successful at it, and we convinced people that we had a plan, we had a process, we knew what we were doing. We had a lot of gray hair, a lot of experience on the team. But that was a significant difference between 25 years ago and now, is who you go talk to when you actually go talk to them. And again, we ended up a lot better on the institutional side than I anticipated.
Yeah, due to a great roadshow presentation that you put on, for sure. So maybe, I don't know if there's other microphones out there does anybody have any questions, comments, things they want to talk about with any of the panelists? If not, we can keep going. Well, everyone's too shy.
Either that or they don't.
There's someone back there?
Somebody was waving.
So the question was, why would you go from private to public if there's such a dramatic discount to NAV in the public market?
Yeah, so, well, that comes and goes, right? So we went public 2.5 years ago. At the time, most REITs were trading at or above NAV. In fact, we did too for a while. So, that part, that cycles through. The one pushback we did get from the retail investors and the advisors who sold in their shares was, the investment had been made years earlier, pre-08, 09, and the value was down substantially from the original dollars they paid. Well, when you list the company and it's traded on open market, you expose that. There was a head in the sand tendency when nobody was publishing a value. You could still believe. Advisors who sold the shares could still believe. The sponsor who sold the shares could still believe. Might not say it, but could still imply that, oh yeah, the value's still there, good assets, great tenants, good assets, good cash flows. We're going to do okay. We're doing fine. When you list it, it exposes that. So just because you don't know what the NAV is or you don't know what the value is doesn't mean it hasn't gone down. So it did make it a tough transition though.
I'll add one comment that one of my good friends, investment bankers, 20 years ago said, because I didn't understand how the non-listed REITs were collecting all the cash that they were, and basically at the time I was in healthcare realty, and we had liquidity, we were traded on the public market, NYSE every day, and we had a higher yield than what they were paying. And my friend looked at me and said, some people don't want to know what the value is every day.
Was there another question? Right in front here?
Yes, I just have a question. If you sell the assets at market value, even though that the NAV is 25% discount, when you get your proceeds after paying taxes and closing costs, you're going to end up with pretty much 75% of the sales price. Isn't the market accounting for liquidation?
There's some of that, although a true NAV should be net of all that, should be measured net of all that. But you're right, it's back to the friction that Luke talked about earlier. If the discount's not big enough, if you're just constantly buying, if you're buying back shares every time you drop 5 or 10% below NAV, and then you're selling when you're 5 or 10% below, the friction of that and the cost of those transactions, including selling assets or borrowing money to create the capital to do that, doesn't make any sense.
Yeah, sorry. The one other thing you've seen is when you do get into that position that you've owned assets for such a long period of time, you have almost a zero tax basis. You're seeing companies spin them out, where selling them, there's such a punitive tax impact where you saw companies spin it out. So whether it was Simon spinning out Washington Prime, or VNO, Vornado spinning out Urban Edge, they just had such a punitive tax position. So their taxes definitely come into play, but again, it's as Nelson mentioned, you can't just every time it dips, it does get hard with the frictional cost.
So I think we have time for maybe one more question out there.
How do you handle? I was with AMCO for a long time, and we always had an issue with distributing FFO and keeping up our assets. And as our properties got older, then Wall Street got involved, made us reserve more and more dollars for those older assets. Aren't you penalized? We were always so penalized on the older assets based on their valuation. What do you do?
So just for the crowd here, we're talking about trying to sell old assets versus new assets and how Wall Street is valuing old assets versus new assets and how these guys all deal with that on an FFO basis.
The capital is a big part of it for sure. FFO is cash flow from operations, but doesn't really take into account the capital required to maintain the property. So we spend as much more time talking about AFFO than FFO. But it is, I think FFO is the true measure of earnings over time, but in the short term, managing that, and that's really what you have to look at for dividend coverage, to your point. And I do think you're right. It's a great point. The older, higher cost to maintain assets impact that. So it's something we took into account in our transition, and it really upgraded the portfolio. That very much came into impact on determining what to buy and what to sell.
For DDR, and probably the one positive that came out of the last significant downturn is REITs that were historically paying all of earnings, 100% of their FFO, the payout ratios are much lower. So for the shopping centre sector, it's probably averaging around 70% of true FFO, probably 80% of AFFO. For DDR, we're more like 60%. So we end up with around about 100 million, 150 million of free cash flow every year that's reused to upgrade properties, re-tenant assets, ensure that we are maintaining those, that we don't get caught in the exact position you mentioned where you end up Wall Street penalising you because you have this huge amount of deferred maintenance or huge amount of deferred capex. So I think one of the big changes that you look in the REIT world across all sectors today is that they aren't paying as much cash out. They are retaining more cash. And to be honest, there's just such a great reinvestment story at the moment. We can reinvest capital at 9 to 10%. So from an IRR point of view, it's in the teens, where we're trading on an implied yield of 7. So there is an ability to grow earnings by reinvesting some of this free cash flow that you're earning.
Yeah, and I would say we're kind of in a special asset class because we deal with healthcare real estate. And so our properties are leased to the healthcare providers who basically see their patients in them every day on a triple net basis. So they have a very big incentive on their own to keep it up. I mean, obviously, that maintenance is always an issue with real estate, but in our situation, it's not near as big of an issue because those healthcare providers don't want their patients coming to something that looks bad.
So I think that's kind of all we have time for, everyone. When you're thinking about making your investment decisions and you're thinking about private versus public and in companies versus real estate assets, you should really be considering the management teams that are behind all these decisions, and hopefully you've got a good flavor for three of the best guys out there in the space in different industries, and maybe you'll get to know their companies a little better after this. So thank you guys for participating in the panel. Hopefully everyone enjoyed it, and I know up next you're in for a treat with Tom Arnold and Mr. Walton, which will be a really nice discussion coming up.